Welcome to Chapter 10 in Intermediate Accounting. We are going to talk about property, plant, and equipment. We're also going to talk about intangible assets in this chapter. So let's go ahead and jump right in. So we are talking about long-lived revenue-producing assets. So these are going to show up in different ways, and we're going to cover each of those in this chapter. In this first video, we're going to cover property, plant, and equipment, which you'll hear called PP&E. So we also hear that as personal protective equipment, but here we are talking about property, plant, and equipment when it comes to long-lived revenue-producing assets. Let me just touch on why we say long-lived revenue-producing. So long-lived, these assets at very minimum are going to bring us value for more than a year. This is not going to be inventory that we plan to sell within the next year. This is not going to be some paper that we use up in the next year. This is something that we call capital assets that we are going to show on the balance sheet under long-term assets. And revenue producing, because ultimately, if we have for-profit companies, we are hoping that any assets we put our money into is going to help us produce revenue. So whether it is buildings, if it's a building, it could be a warehouse, it could be an office building, it could be the building that we are actually selling the product and customers are coming into. But the whole reason we bought that building was to allow us to produce more revenue. Then we have equipment. This could be that it is like outdoor equipment, like tractors and big machinery. It could be things like assembly lines, and it could even be, well, we'll see it separate here as well with automobiles. It could be delivery trucks. Equipment, machinery, automobiles, we can use different words for each of these things, but the ultimate idea is it will help us to bring in more revenue. Then we have land. So if you're going to purchase land as a company, you're probably going to use it to put some kind of warehouse on, or maybe the land is what you need to store some of your things, but that's also going to ultimately help us produce revenue. And same thing with furniture. In one way or another, that's going to help us to produce more revenue. The next category is going to be intangible assets. So we'll really touch on that starting in the second video, but we're going to see patents, copyrights, trademarks, franchises, and goodwill. So we'll jump into that more later on. I don't want to dig into it too much now. Then we will have natural resources. So this is something that really has not been talked about in even your financial accounting class, that we're going to get into more depth in this chapter. So we're going to talk about timber, oil and gas reserves, and mineral deposits. Those are all natural resources that we'll talk about coming up. So first, let's talk about capitalizing the cost of any of these long-lived assets. So when I say capitalizing it, I mean the amount that is going to show up on the balance sheet. So if it says building, what number is going to be beside it? What all is that number going to include? If it says land, what all does that number include? Is it just the purchase price? Or is a lot of other things as well? So we'll see with all of these assets, we are going to figure out the initial cost or the capitalizable cost by taking the purchase price, so that big amount that you see that you're going to purchase any of these items at, plus every expenditure needed to bring the asset to its condition and location for use. So we are going to talk about each one of these different assets and what all that could be expected to include, but all of that will show up on the balance sheet. So some ways that we may acquire assets, it could be by purchasing them. That's what we automatically think of, right? It could be that we're leasing them, so that will come up later on. Could be we self-construct these assets. They may actually be donated, or it could be acquired through a business combination. So all of these are possible ways that we're going to acquire different assets, and they'll all be treated differently. We primarily focus, especially in the beginning here, on purchasing, but you will see other things talked about as well. So calculating those capitalizable costs, let's first talk about equipment. What all would we expect to see next to equipment? There's going to be a number there on the balance sheet. What goes into that number? What is that capitalizable amount? So we have the purchase price, of course, any sales tax that we have. We have transportation, so if you had to pay for any freight to get it there. any legal fees, installation, testing, if there's any insurance with moving it from one place to the next. All of those things are included in the equipment. Yeah, even including installation and testing of the product. So let's look at an example. We have a new case study for chapter 10. We've seen so many different companies that we've worked with the prior chapters. So our new case study is Chewtopia, Toys, Treats, and Tales of Joy. So we're going to be seeing Chewtopia all throughout chapter 10. So our first example has to do with equipment. So Chewtopia purchased new machinery to help automate its gourmet pet treat production line. The purchase price of the equipment was $48,500. Chewtopia hired a freight service to transport the equipment to its production facility for $850 and then had to pay $275 for shipping insurance. To accommodate the new machinery, a custom platform had to be constructed and the equipment installed at a cost of $1,400. After setup, there were several trial runs performed to ensure the machine operated correctly. These trials, which included labor and wasted material, was $575. So yeah, even when they run these trials, they say, we have to make sure the machine is working properly. So they had to waste materials in order to do that, to get it maybe at the right speed and all of that. Even those costs of that material will be capitalized. So anytime you see a word problem like, oh my goodness, this is so much information, I suggest that you pull out the information you really need. And here's what we really need here. We've got the purchase price, the transportation cost, shipping, platform construction. We've got the trials with the materials and everything. So all of that totals $51,550. All of that total amount, the $51,550, would show up on the balance sheet next to equipment. So you're not just going to show the purchase price, it's going to include all of that. Then when you go and depreciate it, it's going to be based on the $51,550 because you had to pay for all of that in order to get the machine there and in working order. So what do you think is coming next? It's land. So with land, you're going to include the purchase price, any title fees, real estate agent fees, any legal fees. Also, if there's any taxes, liens, or other obligations on the property. So this could be that, whoever owned it prior to you, they owed some back taxes or they had a lien on the property. And in order for you to get this property, you have to pay that off. So in that case, that's part of the cost of having that you have to pay in order to get this land. So all of those costs would be included. And you know what else would be included? If there's a building on the property that needs to be taken off, like, hey, this is just some old barn and we're just going to have it demoed. So that the cost of demoing that building would also be part of the cost of land. Before we can put our new beautiful storefront on this land, we have to get rid of that old junky building. The demo for the building would be included for the cost of land. If there was a sinkhole in the land that we have to fill in before we can actually use it for what we want to, for our intended purposes, then that would also be included in the capitalized cost of the land. So let's look at Chewtopia. They purchased 8-acre piece of land along with an existing warehouse for $620,000. The company intends to tear down the old structure in order to build a new state-of-the-art production and packaging facility for its premium pet treats. In addition to its purchase price, the company made the following expenditures. So here's the rest of our expenditures on top of that $620. We've got insurance, commissions, delinquent property taxes, and then there's current property taxes. Now listen close here because this could definitely throw you off in your homework. So we paid $620 for the land. We had to pay for that title insurance to get it. We had to pay the commissions probably to the real estate agent. The delinquent property taxes are from the previous owner. We have to pay that $3,200 in order for us to get the land. The current property taxes, however, those are going to be a separate expenditure. We don't have to pay the current property taxes in order to acquire the land. We just have to pay those to keep the land. So you're going to see here, we're going to take all of those numbers And we're going to consider those, but we are not going to put the current property taxes in there. So shortly after closing, Chewtopia paid a contractor $9,000 to tear down the old building, remove it from the site. An additional $4,000 was paid to grade the land. So here's all of our expenses that would be capitalized. The purchase price, which included the old building, the title insurance, commissions, delinquent property taxes. We had to pay those to get the land, but we left off the current property taxes because that's a separate expense. That's just going to be an ongoing expense each year. The cost of removing the old building that we just saw and the cost of grading. All of that will be included. And so when we look at the balance sheet, it will say land and it will have the $655,200 beside of it. So whenever they first purchase this land, they're going to debit land for $655,200 and they'll credit cash or a payable. So what about land improvements? So this is when we add something like parking lots, fences, sidewalks, lighting, even landscaping that we put a lot of money into. When we add all of that to the land, we are going to account for those separately. So here's the thing. What you're going to see later down the line is land is one of the only assets that fall under property, plant, and equipment that we don't depreciate, because land is going to be there no matter what. Like, it's part of earth. But when we add things like this that we're looking at with land improvements, those are going to deteriorate over time. We're going to have to fix and maybe put in a new parking lot. There's going to be repairs and eventually we have to put in a new fence. Same thing with landscaping, sidewalks, lighting, all that stuff deteriorates. So on the balance sheet, you have land that does not get depreciated, and then you have land improvements separately that is depreciated to account for all of these things. What's next? Buildings. So when you have a building, you're going to have the purchase price, title fees, realtor fees, legal fees, remodeling costs, even if you have to do that in order to get the building to where you want it to be able to use it. So it's not that 5 years down the line, we painted one of the rooms because somebody, didn't treat the walls nicely. It's not that necessarily. It's going to be getting those remodeling costs. Maybe, okay, we bought this building, the whole thing really needs carpet. When we put that carpet in, that's going to be included in the capitalized cost. So that kind of thing we have to take into consideration, and we're going to capitalize all of that. Then we jump to our natural resources. I love this picture. I love the woods. They're so beautiful. I love trees. So natural resources, timber tracts, mineral deposits, oil, gas deposits. So when it comes to natural resources, the cost of those could be that they purchase them, and that would include the purchase price, any other necessary costs to bring the asset to the condition and location for use, just like we saw with property, plant, and equipment. It also could be developed. So they may have bought this piece of land, like what you see in the picture, and then they're like, okay, what we're doing with this is we're going to cut down all the trees and we're going to turn those into woods that we can sell it to a builder as timber, and they can, they can build houses with it. So if that's the case, we're developing this piece of property. We're going to have the acquisition cost of the property. We're going to have exploration costs, development costs, and even restoration cost. So it gets a lot trickier with natural resources, and that's what we're going to jump into here. One of the most challenging parts is our asset retirement obligation. So our ARO. This is the legal obligation to dismantle, remove, or restore long-lived asset at the end of its useful life. So you may see this, let's say it was a coal mine, and you said we're going to go in there and we're going to be digging, and I don't know anything about a coal mine. I feel like I should have chosen something I knew more about. But we're going to go in there and we're just going to destroy the land to mine for coal. And when they do that, they may have, whoever sold them the land, or maybe that the city told them, you can do this, but then you have to restore it back to the way it looked before. Or maybe if they go in and they cut a bunch of trees down for timber, they then say, okay, that's fine, but you then have to go in and plant a bunch of trees so that we're not in the Lorax here, right? So those costs to get it back to where it was has to do with our asset retirement obligation. When we're finished with this piece of land, we may have an obligation to get it back to the way it was before. So this is recognized, this obligation, this financial obligation, because it's going to cost to plant all those trees, or it's going to cost to, smooth the land back out while we were digging. Do you dig for coal? I really need to look into that. So they want to recognize that in the financials when the company acquires or constructs the asset and there's a known retirement obligation. It is recorded at the present value. So we're going to work with that in a minute. And the ARO, the asset retirement obligation, increases the asset's cost that's going to show up on the balance sheet, that capitalized cost. So let's work through an example together. Chewtopia acquired the rights to extract rare mineral used in its all-natural pet supplement line from a 400-acre site in Colorado. The company paid $1.1 million for the mineral rights. Okay, so there's that initial cost. Exploration costs to locate and evaluate the mineral deposits totaled $875, and intangible development costs for drilling and preparing the site were $525. Chewtopia also purchased, listen to this, a specialized extraction equipment for $650,000. The equipment's expected to be sold once extraction is complete. As part of the agreement, Chewtopia contractually obligated to restore the land for recreational use after its extraction. The restoration work will be completed in 3 years. So they have this property for 3 years. It's 400 acres. They're going to be mining for whatever mineral they're putting in this all-natural pet supplement. Hopefully that's not coal. And ironically, I have a dog named Cole, so we're talking about pets here. So they pay for the land, they pay to evaluate it and explore it, they pay for development of it, they also pay for a machine, but they know that they're going to have to pay to get the land back to where it was at the end of 3 years. Okay, so that's what's happening here. So the company estimates the following probability weighted cash flow scenarios. So we're going to use the cash flow of 3 different possibilities. It may cost them $200,000. There's a 20% chance it'll cost them $200,000. There's a 50% chance it's going to cost them $350,000, and there's a 30% chance it's going to cost them $500,000. And you see at the very bottom here, it says their credit adjusted risk-free interest rate is 8%. So we're going to use 8% when we get to our present value. So here's those probabilities, okay? We've got the $200,000. There's a 20% chance of that. What we do first to get our expected cash flow is we take our $200,000 times 20%, then we get $40,000. $350,000 times 50% gives us $175. $500,000 times 30% gives us $150. We add those up, and the $365 is our best estimate as to how much it's going to cost. And that makes sense. I mean, there's a chance it'll only be $200,000. There's a much better chance it'll be $350, and it may be even higher. So we kind of come to the conclusion of our best estimate is $365. So that's basically what they're going to expect. So we're going to use our present value factor. They're going to the present value table, 3 years at 8%. They gave us the 8%. They told us it was 3 years till they had to do it. So they give us this factor, and that brings us to the present value of $289,758. So when we come to figuring out how much it's going to cost to capitalize this, we take the purchase price, the exploration cost, the development cost, and then this $289 that was the present value of the asset retirement obligation. We are missing one thing from this, and this is the piece of equipment, but we're going to keep that separate. So the total capitalized costs that will show up on the balance sheet for this mineral deposit will be almost $8 million. So then let's look at how it's treated later on. So we've got this whole amount. Well, first of all, let's record the asset. So we debit the mineral deposit for this amount that we've come up with. We're crediting cash for the amount we paid out, which were those top three numbers. But then the asset retirement liability, we're going to set to the side at the present value of that. Then we go ahead and record that excavation equipment separately. So we'll have the mineral deposit on the balance sheet and the excavation equipment separately. Then we have the asset retirement obligation as a liability at the present value. Well, how do we get this to its real value at the end of 3 years? We're going to have to make a journal entry each year at the end of the 3 years, and it will bring us up to the full $365 that we're expecting to pay. So we take the present value, multiply it times our 8%, and that tells us how much the expense should be. We call this an accretion expense. So that amount is then filled in as an accretion expense for the first year, and then we add to the asset retirement liability. The second year, we take the new balance. We had the old balance plus the amount we just added to asset retirement liability. We take the new balance times 8%. In the second year, we'd have the $25,035 would be our accretion expense, and then we'd add it to our asset retirement obligation. Then we would do the same thing for our final year, and that brings us, with a little bit of rounding, to $365, which is what we're expecting to pay. So at the end, they find out their actual costs are $395. So here we have accumulated or we've accrued for $365 over these 3 years, when in reality it cost us $395. So our final entry here for this would be to get rid of the asset retirement liability. We pay them cash of $395, so then we show a loss of the $30,000 difference. So this is how we account for the asset retirement obligation. I'm going to stop the video here. Make sure you stay tuned for the next video where we talk about intangible assets.